Did you know that the Consumer Price Index in Canada increased by 4% year over year in August, which was higher than the 3.8% that people were expecting? But what does it mean for us and future interest rate for Canada? For this week's video, let's dive into this. Let's break down the CPI report we just got and really see if the number is as bad as most people say they are. Now, before we do that, make sure you help us like this video. This is the best way to support us. Alright, without further ado, let's dive into today's video. So we're going to first start off with the headline inflation, which includes all items in the CPI index. On Tuesday, September 19, StatsCan released the latest CPI report, and in August, Canada saw its CPI rose by 4% from the previous year. This is up from a 3.3% increase in July. Now, this acceleration is really mainly due to a higher gasoline price. But even without counting gasoline itself, CPI still rose 4.1%, which matches July's 4.1% number. Canadians also have to shell out more for rent and also mortgage cost, though there are some decline in prices for travel-related services and a smaller increase in food price compared to previous months. So let's dive deeper into these numbers and see how they affect our wallet. Gasoline prices played a huge role in the CPI increase that we just saw. For the first time since January 2023, gasoline prices saw a year-over-year increase. In August, there was a 0.8% rise, a noteworthy rebound from a hefty 12.9% drop that we observed in July. So what changed? Now, there are a couple of factors at play here. One of them is what they call the base effect. The base effect is basically math. It just means that the baseline that we use to compare to a certain number right now. So in this case, because we're looking at year over year number, the base that we'll be comparing will be August 2022, where gas fell 9.6% from July 2022. So with this huge drop, now the increase looks a lot more apparent with such a lower base. Now, other than this, another significant factor contributing to this increase is the surge in crude oil prices. Now, crude oil is the raw material used to produce gasoline. As such, when its price goes up, it's only natural the cost of gasoline will follow as well. But why is crude oil surging? Well, that's because OPEC have decided to further cut their production to prompt up the oil price. Now, there can be many reasons explaining this. Partly, obviously, is greed. They don't want oil price to be too cheap. And partly, I think it's probably political reason with US election coming up 2024. But this is not the video for it. We just need to know that because of oil production cut, oil is more expensive. This is pretty important because a surge in crude oil price can also lead to higher costs for goods and services relying on transportation such as grocery, travel, and obviously when we put our gas in our car. So next time when we're at a gas pump filling up our tank, remember these numbers. Now, other than gas that is surging, Canadians are also facing a higher cost in rent and mortgages. In the month of August, shelter prices, which include rent, saw a significant year-over-year rise of 6%, up from a 5.5% in July. This was something we discussed in our last video. High mortgage rates means stronger barrier to become a homeowner. So if less people are able to buy, more people are going to be staying in rent. That increases the demand for rent and prompts up rental price. Combined with a much higher immigration and international student numbers, we're seeing a massive upward pressure in rental. The provinces that are experiencing the fastest rental growth are Newfoundland, Alberta, Nova Scotia, and Manitoba. Not only that, the mortgage cost index is also contributed to a rising shelter cost. It went up slightly faster in August at a 30.9% increase year over year versus July's 30.6%. Not surprising, and I think this will keep trending upward at a faster pace since more and more low-rate mortgage holders are now renewing at a much higher rate every month. Now, the interesting part about this is now with higher interest rate, if we keep increasing interest rate, it's going to bump up our mortgage rate and also make rent higher in general, which will be counterproductive in our fight against inflation. So we'll talk more of that in a later video. Grocery shopping also became pricier, though the growth rate slowed down a little bit, so let's break this down. In July, grocery price has seen a climb of 8.5% year over year, which was a significant increase. But come August, the growth rate did slow down. So grocery price only increased by 6.9% year over year. Like I say only, it's still quite a bit, but it's slower. However, if we look at the month-to-month number, from July to August, food on average, the price actually went down 0.4%. Now, while this may seem like a bit of a relief, it is important to remember that this is still a significant increase. However, this is not a blanket increase across all grocery items. The price for specific grocery items show different growth rates, with some slowing down and others increasing quite a bit. This elevated price trend, coupled with the rise in costs for other essentials like rent and gasoline, really is putting a strain on Canadians' monthly budget, and I'm sure everyone, including myself, is feeling that right now. However, the price increase is not uniform across all provinces. The one that has been hit the hardest is actually Alberta. Now, this province, known for this vast oil and gas reserve, is experiencing a surge in energy price, increasing 13.3% year-on-year in August, following a 7.7% decline in July. Driving force behind this, like we just talked about, is really a lethal combination of high summer demand and an uptick in gasoline price. Now, but there's more to the story. Alberta also saw a substantial year-over-year increase in electricity prices, 121.7% increase in August over a year, which followed a huge price hike in July. This was a direct result of a phased-out provincial rebates ending in spring of 2023. Now, without these rebates, the cost of electricity became a much heavier burden for many people living in Alberta. So all in all, headline inflation is up. This is not good. This is not good for our fight versus inflation. But does that translate to a guaranteed price hike that will be coming in October? Well, in my opinion, not necessary. For a couple reasons. First of all, this headline inflation reading is not a surprise to Bank of Canada. They're not taken off guard for this. On September 7, Tiff Macklem, the governor of Bank of Canada, already has been noting an increase in oil price and says they expect an headline inflation will go up in the near term before it eases. So this print of 4% is somewhat in line with expectation. Also, we had a pretty substantial interest rate hike last September and October for 0.75% and then 0.5%. These contributed significantly to a sudden jump in sheltering cost. So again, if we are factoring in the base effect, just as how it affected our gasoline price this month, in this case, soon our headline inflation reading in November, after these hikes should be outside of the year-over-year increase, should help our CPI reading. Now, last but not least, while the overall inflation has increased, there is some encouraging number within the core inflation numbers, which exclude food and oil. Compared to July, we've only seen a 0.1% increase. This is very important as Bank of Canada have stated they care a lot more about core inflation. And it does make a lot of sense if you were to think about it. Because if you consider the big three, which is food, oil, and shelter, I really can't see how any more hikes can help. Because let's take food example. It doesn't really matter what the interest rate is. At the end of the day, people have to eat. And for gas, no matter what the rates are, OPEC, as we've seen, has way more power on controlling oil prices through cutting production versus the only tool that our government has, which is increasing interest rate. We've also already seen that more rate hikes are going to contribute to a higher rent and higher mortgage costs. So for this part, at least, it's very obvious that increasing rates any further, at least drastically, it's going to be counterproductive, especially with recent renewals. And hiking rates really is to aim to slow spending and economy's growth, which should, in theory, reduce prices. And we are actually doing this because from our second quarter GDP report, we are seeing that people are spending less. Growth in real households slowed to 0.1% positive in the second quarter from a plus 1.2% in Q1. There are also quite a bit of decline in passenger vehicles, furniture, durable goods for outdoor recreation, and natural gas. On the service side, household spending is unchanged for Q2. Household spending per capita, however, actually fell 0.7% in Q2. In fact, it has been declining for the last 3 of 4 quarters. To add to this, we also should expect a salary increase to slow soon because non-financial corporate income for Q2 declined for 4 consecutive quarters, and for financial corporations, they have seen a 7th consecutive quarter decline as well. So what that means is corporations' revenue is really hurting and they have been falling quite a bit for a long time already. This really puts pressure for employment and wages. I think if you look at these numbers, Bank of Canada is really getting the trend that they're hoping for, but all in all, there is a much more dominant forces like OPEC notifying some of the implementations. So in terms of rate hike, personally, I would guess that come October, we are probably going to see another pause and then maybe a hike in December. Because I think Bank of Canada also do want to observe inflation for 2 more months to see if it really trends downward. Like they were saying, they expect an uptick and then it would trend downward. But if we don't see this downward trend, then we would probably get a 0.25% come December. Now the market this moment of recording is pricing as if there's a 99% chance of at least a 0.25 increase by December. However, keep in mind this chart changes drastically day by day. So that's basically it. It's a quicker video. I just want to dive into the numbers a little bit. I still think that inflation is somewhat within expectation, even though it's not a great number at this moment. There is some encouraging things going on in there. And this is why I think there's a pause coming in October and then maybe a 0.25% in December. So what do you think? Do you agree with this? Do you think the CPI number is, okay or is really bad? And do you think we have, more than a 0.25% hike coming by the end of the year? And also, what do you think about 2024? Do you still see more hikes coming? I'm very curious on what everyone thinks about the CPI reading recently and the interest rate movement. Let me know in the comment down below. Now, if you like these kind of videos, I do try to upload once every 2 weeks on various different topics. So make sure you subscribe to the channel, click the bell button to get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next video. Bye!